Hi, everyone. Thanks for coming. Today is another episode of our bi-weekly webinar. We have Dr. Raj here as our guest. He's a world-renowned pediatrics cancer researcher, oncologist, real estate investor, entrepreneur, founder, and manager of REIDOC Capital, LLC. Raj went to medical school in India and trained in London, Illinois, and California. Raj has a master's degree from University of Southern California and an MBA from University of Massachusetts. Raj owns and manages several rental properties in Houston and has invested in multifamily syndications for more than 5 years. Last time we talked, he has over 1,700 units currently under management, either with his own company or as a general partner. Raj also has 2 children who had varied interests from arts to computer games. I've seen some of your kids actually talking about financial concepts once in a while on Facebook, so you're doing a good job. And he traveled the world as a family. He's passionate about giving back and supports several charities in India. I met Raj a couple of years ago, and we met on a group online. And since that time, we've been very good friends, both as an operator, syndicator. We analyze deals together. He actually started a mastermind group, which I'm a part of. And we all talk about what are we working on, what our turns, what our roses. So, he's a very knowledgeable doctor in this space. So I'm going to give the floor to Raj and let him further introduce himself and teach us a thing or two about multifamily investing and what we're looking at in 2023. Go ahead, Raj.
Thank you, Bayo. Thank you for the introduction. Thanks for having me in your webinar. So the topic of today is, does multifamily investing make sense in 2023? Because there is a lot of fear out there about real estate in general, economy in general, fear of recession, those kinds of things. So how should, as a passive investor, you should approach multifamily investing? So this is the outline of today's presentation. First, I'll review some basics of multifamily investing, even though your audience are very sophisticated. They may already know most of the things, but for those who are not familiar, I'm just going to have a few slides about multifamily investing and then how we make money in this specific asset class. Then we're going to talk about the past, present, and future of multifamily investing. Before we get started, just important disclaimer, this is for your education only. REIDOC Capital is not a legal, financial, or tax advisory firm. So please consult with appropriate professional for your legal, financial, or tax questions. I'm primarily going to be talking as an LP or limited partner or a passive investor who has invested in multiple syndications. So just to introduce myself, I'm an academic pediatric oncologist. I'm based out of Houston, Texas. I'm a tenured professor in pediatrics. I wear various national leadership roles, and I publish a lot of papers. I have a master's in University of Southern California, an MBA from University of Massachusetts. As of now, I invested in more than 10 properties, and both as an LP and a GP, and a total of more than 1,700 doors. I am the founder of REIDOC Capital, a boutique investment firm focused on helping doctors invest in apartments. So what exactly is multifamily, right? Most of us are familiar with the picture on the left, which is a single family home. Basically, one family lives in this building. Multifamily is a property where more than one family live, right? It can be a small multifamily like duplex, triplex, fourplex, or a large apartment complex like the one on the right in the picture. So today's talk will primarily focus on a large multifamily. I'm talking about 100 units or more. So we want to own these large apartment complexes. How do you want? None of us, these cost millions of dollars. Most of us, at least, don't have millions of dollars sitting around to buy big apartment complexes. So that's where real estate syndication comes in. Real estate syndication is a group of people we can pool our money together, pool our expertise together, and buy these large properties and enjoy some unique advantages which scale brings. So the first question I always get asked is, where do the returns come from, right? So a lot of people understand single family very well, right? You buy the house, you either rent it, you have cash flow, and then you have appreciation. But what happens in multifamily? Is it the same? Is it different? So there are two main ways we make money in multifamily investing. One is the rental income paid by the investors, right? The second is appreciation. But this appreciation is different from when you talk about single family, right? Single family is appreciation is because there's a demand, people want to live in that house, right? There is some emotional component to it. Multifamily is slightly different. It's more like a business-like numbers game rather than an emotional game. So when you talk about appreciation, there are two types of appreciation. One is natural appreciation, because real estate tends to increase over time, or another is called as a forced appreciation. So this is the example of a natural appreciation in real estate. Right? This is actually a single family home value. If you can see, the median home value keeps going up, except for a slight dip in 2008-10 when we had the crises. But even then, if you can see, it has gone back up. So that may be temporary dip, but long term, the price of real estate keeps going up. This is natural appreciation. So when we buy a multifamily apartment, of course, we don't have any control over the natural appreciation, right? But we do have some control, right? We know where the value is going to go up. The value is going to go up where people are moving in, because there is demand is going to be higher, right? The jobs are increasing, then demand is going to be higher. So the primary markets we concentrate on Texas and Southeast, because we know people from North, everywhere is moving in there, and there is a lot of jobs being generated. The population is growing. So there would be a higher chance of natural appreciation there than any other market like Northeast or Midwest. So the other is the forced appreciation. But if you want to understand forced appreciation is we do something to increase the value of the apartment. But if you want to understand that, we need to understand how the apartments are valued, right? When we decide to pay or bid for an apartment, how do we decide how much money we need to bid on? So that depends on two factors. One is called as NOI, or net operating income. The other is called as cap rate, or capitalization rate. NOI is pretty simple. NOI is total income minus expenses. Basically, how much profit are you generating from the apartment? It doesn't include your debt payment, whatever mortgage payment. So if you make $1 million in rent and you're spending $800,000 in expenses, including like paying the people, repairs, and those kinds of things, your net operating income is going to be $200,000 for that year. So this is something, it's important because it's something we can actually have some control over, right? So it depends on gross income minus expenses. So you can do things to increase your gross income, or you can do things to decrease your expenses. So that's going to increase your net operating income. So when we buy apartments, we try to do both. We try to increase our total income we get and also decrease the expenses. So this is an example where how we try to increase our gross income. Say the figure on the photo on the left is when you buy an apartment. It's not my picture, it's from the internet, but it's a classic example. And this apartment, you can see the countertops, fridge, cabinets that are a little older. So the flooring is old. So we buy it, we put like $10,000 in an apartment. We can spruce up the kitchen, put new countertops, new fridge, new cabinets, or just paint the old cabinets to make it look better. We can improve the bathrooms, put new tiles, low floor toilets, those kinds of things. So then the customer or the client is willing to pay more for this, right? So they're paying $800 on the one on the left. They may be willing to pay $1,000 for one on the right because it's updated, it looks better. And since the value of the apartment is dependent on the net operating income or how much money it generates each year, we are able to increase the value by increasing the rent on the apartment. So let's look at an example. So I'm going to keep it very simple for this presentation. Say we buy a 100-unit apartment complex and spend $10,000 in each unit to upgrade the bathrooms and kitchen, right? So the investment is going to be $1 million because 100 units, $10,000. Then after we upgrade, say we increase the rent by about $200. Okay, that is going to be $20,000 extra income or rental income you're generating per month. And if you do it over 12 months, it's going to be $240,000 extra dollars per year. So we just increased the NOI by $240,000 by investing about $1 million. That doesn't seem to be a lot, right? So just $240,000, you invested $1 million. This does two things. One is going to increase your cash flow every year, but also it's going to increase the value of the apartment. I'm going to show you how in the next slide. Even the $240,000 didn't look like a lot, right? But if you substitute that in the formula we already used, we increase the NOI by $240,000. Say the cap rate is 5% for the apartment. The value of the apartment we actually increased by about $5 million. We spent $1 million and we increase the value of the apartment by $5 million. So it's a good return on investment. So this is how we increase in value. When you say, people say value add apartment investing, that's what they do. They go in, fix things, improve it. And then once we increase the value enough, we sell it off and go on to the next apartment. So this is the basic business plan of investing in apartments. Hopefully that gave you a good idea why apartment investing is exciting and how it generates money for the investors. And it also has a social purpose, right? Otherwise, no one will touch these 1960s, 70s apartment, and they're going to be always like that. So there is an incentive for investors that go in and improve them and make the lives better for the tenants there as well. So that gave you some idea about multifamily investing. Some of the audience here may have invested in multifamily between 2017 and 20. So if you had invested, so please let me know in the comments. My guess is you made a lot of money, right? I don't care about which operator you went with, which market you invested, right? Even in the crappiest market or operator, you probably made a lot of money. So that is my guess. So why is that? Right? So this summarizes that what happened in the last 5 years in multifamily investing. It did not matter. So it's like the rising tide lifts all boats. So it did not matter the condition of the boat, who steered the boat. Every boat did very well, right? So you can replace that boat with apartments. Every apartment did very well. But why was that? Reason number one, there has been astronomical increase in rents during COVID. Not because someone fixed up the apartment. There is a natural appreciation, a natural increase in rent. The average throughout US was about 30% increase in like 4 years. So that's like a massive increase. And some markets, if you see the extreme right, Tampa, the rent increased about 60% during COVID. So if I was an apartment owner, I didn't have to do anything. Apartment which was like $1,000, renting for $1,000, it's now renting for $1,600, and the apartment value like more than doubled without me doing a lot of hard work. I didn't have to be a good operator. I didn't have to do anything. The natural appreciation helped everyone, and everyone who invested in an apartment made a lot of money. The second reason is government printed lots of money too, because people had lots of money. The government printed so much money. Everyone was looking for a place to invest this extra money. They were not spending in a vacation. They are not doing other things. So they had to invest. And multifamily was a very attractive place to invest because the returns were increasing, the rents were increasing. Everyone wanted to invest in multifamily. What happens when all this money is trying to come into multifamily? The cap rate goes down, right? So cap rate is basically how much someone is willing to pay for an apartment as a product of the NOI. So when everyone wants to invest in apartments, the cap rate goes down because they are willing to pay more for an apartment. So when you're going back to our formula, the apartment value is dependent on net operating income and cap rate. So in the last 5 years, the net operating income went up because the rents went through the roof, regardless of what the operator did. The cap rate went down because everyone wanted to invest in apartments. So the value shot up, right? I didn't have to do anything. If I own an apartment, I made a lot of money. Then this happened, right? So everyone was having a party, but party doesn't last very long or not last forever. So the inflation shot through the roof. And in response, the Fed started increasing the interest rate at an unprecedented rate. And at the same time, they did winded down the quantitative easing. So they're pulling back money from the market and increase the interest rate. So the debt cost much more. And then some of these apartments people bought with variable interest rate. Basically, they bought it like 3% interest rate in 2021. Now they have had to pay 7% interest rate. So the mortgage payment doubled. The NOI which was increasing a lot, stopped increasing that much. So a lot of apartments are getting into trouble because mainly of the debt situation. Even though the rents have not gone down, they're still increasing, but the interest rate has gone up much higher than what the rent increase has done. So this graph shows the interest rate increase since 2000. If you see, the current rate is not very high when compared to historical rates, but the rate of increase in the curve on the right is pretty steep. So that's what has caused all the problems right now. So how would I summarize the situation right now? We looked at the past. What is the situation right now is only when tide goes out do you discover who has been swimming naked. So all the people, so if you go to a like apartment investing presentation, they're going to say, my last 4 deals, we gave 30% IRR to all the investors, right? Every presentation you go, people can't, that's what they say. The last 4 investments, we gave 50%, 40%, 30% returns. That was not because maybe the operator was good, but everyone did it. So it's not like a big deal if they say I did 30% returns. So don't rely on the past performance. But people who are not good operators, they're going to suffer in the current environment. So plus there is a natural, not only the Fed has done a lot of stuff, there is also what we call as a real estate cycle. This curve basically represents single family, but it also applicable to multifamily as well. Right, we know that every 10 years there is a natural cycle, and this is the largest or the longest expansion cycle we have had for real estate. After the 2008, 2010, the real estate has been going up and up, but it doesn't go up and up forever. So there are 4 phases. One is recovery phase that's happened after 2008. There's an expansion phase. The phase 3 is hyper supply because everyone gets very optimistic and starts building lots of new apartments or homes. And then we go back into recession. So it's very hard to predict at a time what phase, where in this curve we are. If I have to guess, we are in this increasing vacancy phase. It's between the hypersupply and recession phase. But COVID-19 has made everything not normal. So it's very hard to predict where we're going to go from here. But most people are predicting that we are going to go into recession. And the other thing I want to show you is what's happening right now. So this specific picture came on social media a lot in the last month. This is basically, for those of you who don't know, this is a $228 million foreclosure of 3,200 apartment units in Houston. One operator who had this lot of units, they were not able to pay back the mortgage. The lender closed on those apartments. Basically, every investor who invested in these apartments got $0 back. Right? They lost all their money. So a lot of people are worried, oh my God, this is happening. And there may be more foreclosures coming along, but I don't think it's going to be as much as the market is predicting, because there is already people with money want to invest. Like there are a lot more people with money waiting on the sidelines to invest in apartments, and they're looking for good deals. So I don't think it's going to be like a total crash, but there is going to be more foreclosures coming along. And this specific thing, so this is one of the Twitter. Sorry. All right. Sorry, this is one of the Twitter handles I follow, the Dr. Money. I actually respect him, but he has been predicting that apartments are going to crash for some time. So there is some truth to that, but I don't think it's going to be like how much he is predicting. But this specific apartment foreclosure has also some other background. Right? The operator was very not. At least I don't know them personally, but what I've been hearing is there's like one operator, one guy, and one asset manager managing these apartment complexes, which is never good. You need a team of people to manage these things because these are like $220 million business. You cannot have 1-2 people managing the whole thing. So that's one of the things. And these apartments were not managed very well. Like I just put a clipping from the local newspaper, or I think it's a local TV station. One of the apartments mentioned had a lot of issues, and the Houston mayor had to go there last year because it wasn't managed properly. So there may be other factors other than the economy involved in why these foreclosures happened. So what is happening in the market right now, right? So the rent growth has slowed down in all markets, in all classes of apartment. There is no question about it. Like 2 years ago, the rent was increasing 10%, 15%. It's not the case anymore. It's not at least decreasing. As far as I know, the rate of increase has decreased. Some markets like Phoenix, there may be some decrease in rent as well. So you remember the graph I showed you before about increase in rents during COVID? This is the graph right now when compared to what it's before. I want to make sure you understand this is not, when it's negative, it's not like decrease in rent, it's not increasing as much as it used to. So there's an inflection. That's what they're they're comparing that with what happened during COVID versus now. It's not actually increasing as much as it used to. So you see the 30%, 60% here, like -3 +2. So it's more towards a traditional increase in rent, which is considered as historically, it's 3% increase every year. So that's what you can consider as normal for rental growth. So the other thing which has been increasing is, so what we talked about rent, which is which affects the net operating income. The other thing is the cap rate, which is how much people are willing to pay. So the cap rates of what we call expanded. The lower the cap rate, the higher the value of the apartment. So cap rates have increased. That means the value of apartments are decreasing, right? Some regions more than the others. This is comparing the first half of 2022 to the second half of 2022. Places like Phoenix, if you can see, it went from like 3.5 to 5.25, or 4 to 5.75. What that in practice means is, if the apartment was valued $10 million, the first half of 2022, the second half of 2022, it was basically $7.5 million. Like they lost 25 to 30% of their value by decreasing 1 point of cap rate. So that's what has been happening. So it should not affect the apartment that much if you're operating it properly, and if you don't have to sell the apartment this year, there's a natural cycle, it's going to come back up. But people who need to sell the apartment this year, they are in trouble because the apartment values have gone down significantly. People who have had to refinance their apartments because they had a variable debt, they are in trouble as well. But overall, if you can hold on to the apartment, operate it well until 2025, the Fed is going to, at some point, going to decrease the interest rate and the cap rate is going to come down again. So this is what I told you. So what's happening right now, the NOI is not increasing that much and the cap rate has started increasing. So if you put those things together, the value of the apartment has gone down. So we talked about the past, we talked about what's happening right now. So what's going to happen rest of 2023, 2024, 2025? So if we want to summarize in one slide, I'll say low tide is going to reveal some hidden treasures, right? So there are going to be opportunities. We can use the opportunities and invest in apartments. So it's not like all that bad. This came out, I think, last month or beginning of this month. Blackstone just raised $30 billion for a real estate fund, primarily concentrated on multifamily and the industrial warehouse. Those are the things they're going to concentrate on. So they are getting ready to go and pick all these deals they can have when people get into trouble. The other thing is the vacancy rates. Vacancy rates is, in general, we want 90% or more of the units are occupied. During COVID, the vacancy rate went near 100%. Like people are waiting for apartments, right? Now the vacancy rate is increasing. It's about 5 to 6%. That's actually normal. Normal for a healthy apartment situation, real estate situation. And then the other thing which is favorable for apartments in general is people, there is the gap between the age you get married and the age you buy a first house has been expanding, right? So right now the age at first marriage is 28 for millennials, but the age at which they buy the house is 33. So what are they going to do between 28 and 33? The classic place they live is an apartment, right? So the longer the gap, the more it's advantage of apartments because all these people are going to prefer to live in an apartment. So the demand for apartments continues to be strong and is going to be strong in the next few years. The other thing which has happened is the home prices, even though they've decreased a little bit this year, they're at historical highs, right? So it's very difficult for a first-time home buyer to afford this homes, and the interest rate is very high too. So there's not a lot of incentive for them to go and buy a single-family home. And in most places in the country, the gap between renting and mortgage payment is high, pretty high, historical high. There is about $1,000 difference. If you're paying a mortgage for a single family, you're going to pay $1,000 more than renting an apartment. So there is it's attractive for people to live in an apartment rather than go and buy a single family home right now. Plus the other question which is always asked us, what about all these thousands of apartments being built, because during COVID, what happened is multifamily is doing very well. So then there are a lot of new startups, like new buildings were built, and because everyone wants to cash in on demand for apartments. So it's basically a classic supply and demand situation. There's a lot of demand, so the supply increased. So even though there are many new apartment complexes being built, in many markets, they're just keeping up with the increase in demand. For example, in this graph, the size of the circle represents how many new apartment units are being built, and the color represents the population growth, right? So you want to be green, and whatever size you are, you want to be green. So you want the population growth to be very high. So if you look at many Texas markets, including Houston, San Antonio, Dallas, Fort Worth, the circle is small. That means the supply is not that high, but they're still green. The population is still growing strong. So those are the markets we primarily concentrate on. The Austin, there is some hyper supply going on right now. And this is a prediction from CBRE. This is a big real estate brokerage firm, which has been around for 100 years. And this is what they're predicting for 2023 for commercial real estate, right? In this graph, smaller the number, the better. So their number one prediction is industrial and multifamily, industrial warehouse, because there's a lot of nearshoring going on from China to Mexico. So they're predicting, like in places like Texas, the industrial warehouse is going to do very well because all the goods are going to come into US. They need to be stored somewhere. And then the second thing they're really gung-ho about is multifamily. So in the office, they're not very, they're predicting that office is not going to do very well. So this is a prediction from CBRE for this year. To summarize everything, so why do we still think multifamily makes sense in 2023? The rent usually keeps up with inflation. That's a classic thing, right? The leases reset every year. So even if the inflation is high, you can increase the rent according to the inflation. So if you go for a triple net thing, you lease it for 10 years, there's already a return that how much the rent is going to increase. The lease doesn't reset, but in apartments, typically the lease is reset. And then, even though I said affordable, the rents are high, the affordability of apartments is still high when compared to single family homes. And also, there is a huge opportunity to purchase at discount pricing because of high interest rates. The apartment values are low. So if you can buy up apartments right now, you can actually get a good deal. And then when the interest rates goes down, the apartment value is going to go up as well. So for those reasons, apartment investing still makes sense. And the next one I wanted to show you is this. This is a prediction from Marcus and Millichap. So these are the things they consider top 10 markets for multifamily for this year. So as you can see, most of them are in Texas and Florida. And there are other markets as well. It's publicly available. You can pull the report to see. And they have actually a report on each city, what the demand is, what areas are good, those kinds of things. So I just summarized past, present, and future, what we're predicting for multifamily. But as an individual passive investors, how do you decide which deal to invest, right? So you don't want to, just because someone says multifamily is good, every deal which comes along, you don't want to go and say, I take my money, right? So you have to be able to scrutinize a good operators, good market, those kinds of things. So that's the most important thing as a passive investor. You need to know every brochure out there, every presentation out there looks very good when they present you a deal, right? So everyone says 2 times equity multiple, 17% IRR. So that's like pretty standard. But how do we decide which one to invest versus other? What is our risk profile, risk benefit ratio? Those kinds of things you need to be able to do before you invest, because typically you're investing 50,000, 100,000, sometimes even larger amount in these apartments. So you want to make sure it meets your criteria. Right. So this is what I thought about a lot, and then I came up with this it's a very simple website. It's called passiveinvestingchecklist.com. I'm just going to show you the website right now. Hopefully you can still see. Highly recommend if you're going to go and invest in an apartment, go to this website, because I've developed this checklist for you where you can go through and then answer questions step by step. So it makes sure you consider everything before you invest in an apartment complex. So if you go to the website, there are 2 things you can do. If you have an apartment you're going to invest right now, you can go through this checklist online and start filling it. Or if you want it for future, you can just download a PDF version of it. Of course, the online version is always going to be current because I get new information, I update the checklist. So I'm just going to quickly show you what it has. For example, the first thing you need to do is the only thing which is required is property information or name, because when you get an email, you can know which deal you're talking about. So let's say I'm going to say 123 Main Street, right? So you put 123 Main Street, you start filling out city, state, whatever zip code, and then you go to the next page. The first thing you need to think about, right? So whenever people want to invest in an apartment, they're going to think about, oh, what is the return? They say 2.5 times equity multiple. So I've seen deals where they say 30% IRR, 40% IRR. They even use the term infinite return. Those kinds of things, they are important at the end of the day, but the most important thing is sponsor. So first thing you need to scrutinize is sponsor. That's why I have arranged a checklist in terms of decreasing order of importance. First thing is you need to sponsor. So for example, the first question I ask is, do you know and trust the sponsorship team? If you say no, then don't proceed after that. There's no point in investing. So you need to know the sponsorship team, right? And then so there are multiple questions here. For example, does the team have people with complementary skills? Is it one-man show, or are there multiple people involved there with different expertise? Because one person cannot do everything, especially if it's a $50-60 million business, right? What is their track record? Are they putting some money in the apartment? How many deals are they doing? Have they done? Are they doing right now? Are they doing too many deals? If they're doing too many deals, they may not have time to dedicate to this apartment, right? So I look for people who do 2 to 3 deals a year maximum, not for, if they do 10, 20, they probably not have enough time to dedicate for this one project. Then it goes to the market. What is it, a primary market, secondary, or tertiary market? What is the population growth like? Because we want to invest in a market where the population is growing. I also have links here, so you can actually click on the links to actually get the data where you find the population growth data. You can click on it and it will going to show you. What is the median home value increase? Is the property values going up in that area? What is the crime rate in that market, right? So that's the market questions. And then you go to the sub-market where the property is located. With that area, what is the poverty level there? What is the household income? Household income needs to be at least 3 times, the median household income needs to be at least 3 times your rent the person is going to pay in a year. So if they're paying $12,000 rent per year, like $1,000 per month, the median income must be at least $36,000 for us to be sustainable, right? If the median income is $24,000, no one is going to pay the increase in rent, and there's going to be a lot of vacancies. What is the unemployment rate there? Is there a diverse population there, not just one ethnic group or one race in there? And then also always look for what kind of amenities or stores are nearby, right? That also going to depend on what class of apartments you're buying. So for example, I contact class A and B. I always look for, hey, where is the nearest Starbucks? Because Starbucks has already done the research, and they're going to put a Starbucks store where there are people with money out there, right? So if your apartment is within 5 miles of or 2 miles of Starbucks, that's a pretty good indication that people with money are living there. They can afford to rent the apartment. And who are the employers in the market? So I used to live in a place called Peoria, Illinois. Caterpillar was the only game in town. If the Caterpillar went down, the town is going to go down, right? So I won't go for that kind of market. You want to go for a market where not one employer employs more than 20% of the total employable population. Then even if that employer goes down, there are other employers there. So your apartment is not, that people are still going to be paying rent. Then the actual property itself, the submarket itself, property itself, in general, I recommend greater than 60 units because that gives efficiency. They can employ an on-site manager. I can employ an on-site maintenance person. Of course, that doesn't mean someone with 30 units is not going to do well, but efficiencies comes when we have more than 60 units. And what is the price per door they are paying? What is the class of the property? Is it A, B, C, D? A is the highest level where you and I would want to live in. B is slightly lower. C is like workforce population. D is something you should not invest in at all. And what is the location? So those kinds of things. What is the current occupancy? You generally want the occupancy of the apartment to be about 90% or above. If there are 100 units, 90 units should be occupied right now. And only 10 units should be maximum be empty. Not only that is important, there is a concept called economic vacancy, where there may be 90 units occupied, but only 80 unit tenants may be paying rent. That means your actually physical occupancy is 90%, but the economic vacancy is nearly 20%. That's not good. That means people are not paying rent. They're still occupying the apartment. You're not going to make a lot of money. So those are the things you can either find these out from the operating memorandum or offering memorandum they're going to give you with slides and stuff. Or you can ask this in webinar when they conduct, or you can just call up the sponsor and say, hey, I need you to answer all these questions, and then ask these questions and go through the checklist to make sure you're able to answer all those things. After only you've gone through all those stuff, now you go to the projected returns, right? Our tendency is always to be projected return first, but you have to scrutinize all those things first, then go to the projected return. Look at what is your cash on cash return, internal rate of return, equity multiple, how often do they distribute the money, and when is the initial distribution going to start? So all these questions you can ask before you make a decision about investing in that partner. And other things you need to look at, I'm not going to go over these things, but what kind of financing they have. So when you do the checklist, you ask all these questions. Is it a fixed rate, variable rate financing? What is the loan to value? The higher the loan to value, usually higher the risk. What loan to value means, if the apartment costs $10 million and the loan is $8 million, the loan to value is 80%. Right, so you're raising, the investors are doing other $2 million. So the higher the loan to value, the higher the risk, but also the higher the return. So you have to know those things. And then you ask the sponsor, what are you assuming here, right? So they're going to tell you, I'm going to buy it for 10 million. I'm going to sell it for 20 million. Okay, how are you going to do it? What are the assumptions? What is the rent increase you're assuming? Are you predicting that you're going to increase 10% every year? That's not practical. So you'd ask, what is your prediction for rent increase every year? What is the prediction? What is the cap rate is going to be when you sell the apartment? And how much are you going to spend for rehab? If they say, I'm going to spend $3,000 on rehab, but going to increase the rent by $200, that's not practical. The rehab is not going to be that much, and the rent is not going to go that high. So you need to know the market rate. Right now, at least this year, depending on the apartment, most of them markets, it costs about $10,000 to rehab the unit. And then, of course, last one, the next one you want to look at is what is the fees involved, right? Is there a preferred return? What is the LP-GP split? Is it 70-30, 80-20? What is the common split? What are the different fees, asset management fee, acquisition fee, disposition fee, and is there any other fees involved? So you can go through the checklist and write all these things down. And then you also ask them about the business plan. So you're saying $200. How are you going to increase it? Are you just going to do kitchen and bathroom? Are you putting covered parking lots? Are you going to put low floor toilets? So you need to understand what is a business plan. How are they adding value to the apartment? And then the last page I have is your own gut feeling, right? That's the most important thing. I say, what is your gut feeling? Do you want to invest in this deal after going through these 7 pages? If it is yes, of course, you proceed and look at other things. If it is no, then of course you do. And what is the investment amount? Where are you going to get the funds? Those kinds of things. Once you fill in all those stuff and you put in your name and email address, then you get an email with a summary of everything you filled out. So that's the record. So if you're looking at 2-3 properties, you can fill it out for 3 properties and you can actually compare all the data you get from that. Or you can download the PDF checklist. And I also have a video here which explains to you how to go through the checklist and everything I talked about. And then you can also make an appointment with me if you want me to go over the deal with you and go through the checklist and explain to you how it works as well. So with that, I'm going to stop the presentation.
Thank you, Raj. That was very comprehensive. You went through the market trends, macroeconomic trends, and also give us a checklist of what to do. So basically, you did 3 presentations in one. So that was good. So if you have any question, guys, please put it in the chat. I'm gonna, start off. I actually had about 11 questions, and you actually answered like almost all of them in your presentation. So that was good because I always have the questions, just in case. So I'm gonna start off with I saw you had a slide about Class A, Class B, and C. And I know we've been talking, me and you, for the past 1 year, and we argue about Class A and Class C. We do, Class, C plus, B minus, with a few Class A's. We're actually not seeing a decrease. In fact, we've been able to increase the rent, in almost all our units. So just trying to understand, how do you approach these classes, class A, B, and C, in terms of recession? What's your own opinion about it?
Sure. So, of course, my first few deals I did was Class C. So the traditional, just reinforce, Class A is like a apartment you and I would like to live in, all amenities, New York thing, new built apartment. Class B is slightly older, less amenities. Class C is usually workforce apartments, right? So as I said before, Class C is one usually gives the highest return when compared to Class A and B. But also it has a higher risk than Class A and B usually. But as like any real estate is always local, right? So you cannot just generalize for every market or every situation.
Sure.
What happened during 2021, 2022 is, so traditionally the cap rate for Class A would be like 3, 4, Class B 5, 6, and Class C 7, 8. But during the COVID times, all of them compressed together. Even Class C was having like cap rate of 4, which doesn't make sense, right? So Class A is 4, 3.5, Class C is 4. If you're buying Class C apartment at a cap rate of 4, and now the cap rate is expanding more for Class C than Class A, because Class C, as I showed you, it's expanding. So then the risks are higher. You're probably not going to make a lot of money if you bought it in 2021 and 2022. So that's what. So it has to be the right price. You have to make sure you're not overpaying for a Class C apartment. The other reason Class C is considered higher risk is if it's older, like 1970s, 80s, sometimes the chiller breaks or the heating breaks, right? It has to be a major expense, or you have to replace the roof. As long as you underwrite for it up front, do a proper due diligence. The other major thing is the sewer lines, they get blocked and there's an issue, then you have to replace all this. Those are major expense items. So due diligence needs to be proper, and you have to have adequate reserves for Class C. You have to raise enough money to have reserves in case of unexpected things. Then you can still make money. So Class C involves more work for the operator, to be honest, because there is more tenant turnovers and those kinds of things. So the operator depends more on operator skill. Class A probably less on operator skill than Class C.
Yeah, I mean, I do agree with you. There's a lot of deferred maintenance. We actually have a criterion never to buy anything below 1980. And we're now actually trying to move it to 1984, 85. Mm-hmm. So we do, if everything works well, and the only thing left, like it's, the numbers are good, everything is perfect, good area, and it's like 1978 and 1979, we might consider it anyways. But in general, though, yes, I do agree about deferred maintenance. But like you said, with investing, it's almost always risk versus return. If you're going to get a higher return, you almost always have to increase your risk a little bit. So, and that's what many operators don't tell investors, because, people just see 3x return and they get so excited about it. But the truth of the matter is, 2x return where you can't sleep at night versus a 2x return where you can sleep peacefully. So you make your own choice sometimes. But like you also said, it's local, like a local market. In the same market here, there are places where you can increase rent by 10%, and there are places that you can barely increase by 3%. So even in the same town, So I think, like you said, it's very local. So do we have any more questions? If you want to come on video, you can. Just let us know. And so another thing is also, how should investors balance short-term cash flow with long-term capital appreciation in their multifamily properties in 2023? Because the reason why I'm asking this question is, right, before we were giving 10% cash on cash. It was even like 2 years ago, there was one senior living, we projected about 12%. It was that good. But now the last deal was about 6%. And there's a lot of questions about it, like, oh, why is the cash on cash return so low? Although the final return actually seems like it might be higher ultimately, like the multiple. But it was difficult for investors to understand that, there's lower cash on cash return. So can you just explain how you can balance both, the short term and the long term capital appreciation versus the, short term cash flow?
So there are a couple of things here. One, as a passive investor, you have to be clear about what your goals are for the investment. Right? So I think majority of my investors, at least, are physicians, and their goal is long-term wealth. They're not like retirees looking for this as an income every month, cash on cash return, right? So if that is the case, right, you are going to depend on this cash on cash for everyday living, then there are other things which will produce more money, like ATM investments or whatever other things you should look at. So that's one aspect. You have to look at your goal, and most of my investors' goal is building long-term wealth. For that, cash on cash itself is not important. How much money you make at the end of the deal is what's more important, right? But there is also to understand where the cash on cash return is coming from. Cash on cash return is basically, we talked about NOI. So and we get $200,000, and it's split between the investor and the bank. So if the bank's interest rate is high, bank is going to get a larger cut of it, and investor is going to get a smaller cut. So that's why the cash on cash return has gone down, because our interest rate has gone up, our payment to the bank has gone up, right? So that's why the cash on cash. But overall, cash on cash traditionally doesn't contribute a lot to the overall return. So even if this is 6%, the overall return seems to be good because it depends on your selling price. That's what most of the value add. It depends on how much value you add and what price you can sell. So 6% is actually the standard right now. Most of the deals we have is about 6%. So that's what I would look at, is what is the long-term goals and understand how cash on cash works. And for me personally, my long-term goal is grow wealth. I don't care about how much money I get every 3 months. Of course, it should not be zero, because we want him to have positive cash flow, positive NOI, but 6% is completely fine with me.
Okay. So another thing is, I know you're very big into technology, and you're helping me so far, my team, with how to automate many of my social media posts. I still post about this webinar, use my VA to post things, and you already scheduled everything for the year, for example. So, so my question is, how important is technology in multifamily investing, and how will technology impact the landscape? In terms of how much people you employ, and is it going to save us syndicators money, or is it going to, how is it going to affect long-term outlook and returns?
So there are a couple of aspects to it. So let me first think about the passive investor side, how the technology is going to help, right? So one of the major disadvantages of multifamily investing or syndications is the money is illiquid, right? So you put the money in, it's not a publicly traded security, so you cannot just go out and sell it to someone else. So it's illiquid. So people are out there trying to solve this problem by using blockchain technology, for example, trying to put these as, I'm blanking on the name. It's not crypto for sure, so don't worry. It's a blockchain technology. They're trying to make it's like a unit. You're basically buying a unit of blockchain and you can sell it to someone else, kind of thing. So they're trying to make it less illiquid, so that you remove the major friction point for a lot of people. A lot of people don't want to say, hey, put the money in, I have to wait 5 years. By using blockchain, they're saying they're creating a marketplace for passive investors to sell their thing to someone else. So that's coming in the next few years. So that's going to help the passive investor. And of course, for the syndicator active property manager side, for example, you're also involved in the same property. So tenants are demanding more technology for themselves, right? More smart thermostats, EV charging, right? A lot of electric vehicles. So these can be value add stuff. We give technology to the tenants and they're willing to pay more money to us, so we can increase the value of our apartments. So that's the other thing we can do. And I mainly raise capital. I'm not an operator, even though I want to become an operator mainly in the future. So there are also other technology platforms which help you start a fund, for example, pretty easily. I've been talking to some technology people where it's what he calls a flexible fund. Traditional fund disadvantage is you put your money, you don't have any control over the money. You have to rely on the guy who's raising the money to do stuff. But there are fund structures out there where you become part of a fund, but the investors can decide which property they want to invest. They don't have to invest in every property in the fund. So there are a lot of technological things happening around the multifamily or real estate space. In the next few years, it's going to be exciting.
Okay. I mean, it looks like it's mostly positive. Can you think of a negative? For
the technology, I don't know. Specifically for multifamily, I don't think so. Maybe it makes it more easier for people to invest, but that could also be bad sometimes because they may not understand the investment and put money into something because it's easy to do.
Yeah, because actually what you said about fund was one of the reasons that's holding me back from starting a fund. Because many investors are, normally before I do anything, I usually post it in the WhatsApp group, try to get feedback, what people are thinking. And oftentimes their problem is they're like, I like that there's one deal and I know this is the deal and I'm investing in this deal. But once you have a fund, especially if it's a big fund, you have $10 million fund, and now you have to maybe buy 4 or 3 properties in it. And because of that, and because of the way the fund is structured, so basically you're investing in all the 5 properties. It does have its advantages, which means you're more diversified now. Like if one fail, you have the 4 other ones to kind of pick up the slack. But the problem is, it also can decrease your overall return also, right? Because if you look at one deal and you look at this deal is a home run and you invest in that one, and you can individually pick one. But the ability to individually pick even within the fund, that would be quite interesting.
Yeah, I'm actually seriously looking into starting that. That also gives the investors, like a lot of people say, I have $100,000 this year. I don't want to invest in one property. Right here, when you have this flexible fund, you can put the minimum as 20,000, 25,000, whatever makes sense for the operator. So they can divide that 100,000 into 4 different properties if they want to. So there is some unique advantages there as well. So that's why I'm seriously looking into that space.
Okay, that's interesting. We should talk more about it some point later. I do
a question there. Funding pool. So there, I know of a couple of funds which do that already. I'll be happy to send you there. But of course, I'm going to start one. Probably a buyer is going to start one too, so I can participate in any of those funds. Yeah.
Okay. Yeah, you can come on camera, or you can just ask your question. Oh, that's a Fini. Okay. Sorry. Okay. So, okay. Well, let me look through my questions because I know you answered a lot and I don't want us to repeat, but we have 2 more minutes. Let me try to. Okay. You already talked about emerging trends in multifamily amenities and services.
Maya, there is one question. Can you talk more about the K1 tax distribution to investors? It's interesting question. I actually did a separate presentation for K1. It's in my YouTube channel. If you connect with me, I can send you the link. But is there a specific question about K1 tax distribution? Of course, it can be frustrating for investors because a lot of times it can get delayed, and then you have to file extension. For example, I filed my own extension because all my K1s haven't.
I'm waiting for 2 also currently.
So that can be a thing, but it's important to understand the K1 as a passive investor. So I highly recommend if you can connect, or you can go to my YouTube channel. You go to YouTube and search REIDOC.
Actually, let me just find it while you try to talk.
Yeah, I think it may be I don't think it's an unlisted. It's listed. It's basically says K1 statement for passive investors, something like that. So I do like a 40-minute presentation on that, how to look at your K1, what are the important things you need to look at, and what are the things you need to track year to year. For K1.
Yeah, I recommend his YouTube channel. He's very, as you can see, Raj is very information-based, evidence-based guy, and I rely on him a lot. I basically rub brain with him a lot with data. So K1. I'm searching that, and I want to post it here, so we don't have to.
I can look it up too while you're there, in case you're not able to find it.
Okay. Yeah, we can put it up there. That would be nice. And do you have any other questions? And So, Timmy, can you clarify your question also, because I can try to answer your question.
Yeah, I was just trying to see, because you know how they say that as a LP, there's like a limitation on how much you can actually deduct from your taxes as a W-2. I just wanted a little bit more explanation about that, but maybe I'll just go to the YouTube channel.
I just put the link for the specific video. I talked about K1, but I can tell you clearly up front, unless you're a real estate professional, you're not going to get any tax deduction from your W-2 by investing in a syndication as a passive investor. Right? That's pretty clear. So it can offset the depreciation you get in K1. So you can offset your other passive income. Like if you have another rental property, you're making money on it, it can offset that. But it's because I don't even get depreciation from my own W-2. I would like to. I've looked at all the data. There is no way for you to get it off unless you're doing like a short-term rental. You can use that one, or you have a real estate professional status. Those are the only two situations where your W-2 taxes will come down based on these investments. Of course, I'm not a CPA.
Okay, no, that helps. Yeah. Yeah. No, that actually helps.
Yeah, the way we do it currently is that my wife, works. She stays at home, right? So she doesn't have like an actual physical job that she does. So, and since she manages, the LLC, and also she actually loves doing the flips. She loves the flips. So the flips get you so many hours of real estate professional. You need to have about 750 hours a year. So, for the reps, and also your main income have to come from real estate. So obviously, when you first start your few units, you're not going to have as much, especially you being a doctor, So it's going to be tough for you to get to that main income to be real estate. So if your partner is not really making a lot of income, active income, it could be a very, very good way to do it. And we can, work it in a way to, if you bring in more investors or bring big money, you can be part of the GP. There's a way to do it. Or you can just buy a smaller unit like a joint venture and be an active participant. Invest with an LLC with both you and your partner, right? And then make sure you actually actively participate, right? Like, look up the property, go check on it, analyze it. So to get that 750 hours, but if both partners work, it's difficult. Another thing is you have to file jointly, right? Married filing jointly. So to be able to take advantage. So for us, obviously we have a lot of real estate, do syndication. So, we have about $1.3 million of the K1 negative depreciation we can use this year. I'm pretty, I don't know, Raj, let Raj answer that, but I do use LLC, but your LLC can also file as S Corp. So, we do have our main LLC, which is partner, our main LLC, and all the other LLC that we invest in are usually partnership. But you can, elect to file as an S Corp, even though you have an LLC. So that's a two separate issue. And like Raj said in the beginning, of course, talk to your CPA, but I can tell you what I do on my own side, and we can talk more about it. But so LLC, the issue of LLC versus S Corp is a two separate issue. LLC itself is just how you register the company. So you can have an LLC, but you can file the tax return of that LLC as a partnership, as a S Corp. So so the two separate things.
Great. So yeah, Bio knows more about it than I do. But what about the other comment I saw is K1 income is added to your income and taxed. That's true, but most of the time, at least in real estate syndication, when you get the early distribution of cash on cash, it's usually not taxed because your depreciation will offset it, right? So usually we are going to give you a K1 statement saying you lost money. We are not going to say you made money during the whole period. When you get the final K1, that's going to be positive. That's when your tax implication comes. But that would be a capital gains tax, not an ordinary income tax, because we held it for that long. It's going to be 15% or 20% depending on your income. So one of the advantages of real estate is lower taxes. And even that one, there are ways to mitigate it by, if you have other passive losses, say on the year 5, you had invested in other syndication, you have $100,000 loss and you hear $100,000 gain from selling the property, they're going to offset each other. So there are ways to mitigate that too. So that's one of the great advantages of real estate is tax. So whatever income you're generating from real estate, it's possible usually to shield it from taxes, of course, legally, but W-2 usually not.
Yes, I'm going to just add to that. So, for example, like watercolor, right? I think, Raj, we're both GP on that deal. So for watercolor in Northwest Arkansas, we have about 120% of tax benefit. It was such a high number. So let's say if you invest 100K, right? Because a new build. So, and you get even first year, you might have like maybe 80K, right? Out of that 120, right? That you're going to get ultimately depreciation. So, but then you're only getting 6% cash on cash in your first year. So you're only getting $6,000. So you're still going to have a negative $74,000, okay, that you can use for next year distribution, the year after, all the way to the 5th year. And then when you exit, though, you might have already used half of that or some of it. So that's why it's saying it might be positive. But there's a chance that you already do another syndication that year that you're exiting. And then that one already give another depreciation of like another 50,000 or something. So when you put it together, and then the money you actually invest in the deal itself is not taxable, right? It's actually your investment capital. So if you get back your 100K, but the extra 100K you get is what's going to be taxed. But if you already have like another 100K, depreciation, then you pay no tax. So that's how usually real estate works. Your job and your CPA job is to make sure you use all the tax advantage, all the tax rules to your advantage. So, okay. Any more questions? Because we are already a little bit past the hour. And so thanks, everyone. I really appreciate it. And I forgot to say, George, my co-host, is actually in Dallas in a real estate guys. They have like the conference which he goes to. So he couldn't be here today. And so he's going to be here in the next 2 weeks again. So thanks, Raj. I really appreciate it. And I'll be on your podcast tomorrow.
Thank you, Bayo, for inviting me. Thanks, everyone, for attending on a Saturday evening. Okay.
Yeah, thanks, everyone. Take care. Bye.